Well, welcome back, traders. It's a beautiful Sunday here in Northland, and I was out yesterday with my son and my wife, and had a birthday celebration with her daughter, so that was fun. So I'm going to do my weekly 5-minute update today, and also roll in the last of my tutorial videos, which is just a summary of everything I've kind of shown you thus far. So let's just rip into the weekly numbers, and you'll see on the screen my weekly spreadsheet. Just have a look at that. So we've just closed out week 6 of the 52-week plan. Small profit of 1.4%, which is still fantastic. Overall for the 6 weeks, we have an 83% week by week win rate. Realised an overall profit of 10.11%, and that is fantastic. So I'll just keep doing updating the spreadsheet every week and seeing the results over a whole year. So let's look at the week ahead with baby pips. We'll just pull up the browser here, and you can see in the economic calendar for the week starting the 20th of June, the 20th of July, which is their Sunday. They open Sunday, 5 p.m. New York time. So effectively, we open on a Monday, 9 a.m. tomorrow on the Monday. But the week ahead, we have no real major news until Wednesday. There's a Jerome Powell speech. He's the head of the Fed, so that has a very high impact on the market. We want to be out on the Wednesday. Not too much to worry about until probably Friday. So some good trading opportunities next week. Mondays and Tuesdays I find are the best days to trade. Fridays and Saturdays our time are the worst, because at the end of the week the market makers will spike and move the markets and try and confuse the crap out of all the retail traders, and it's quite hard to pick what happens on a Friday and a Saturday. So get your trades in on a Monday, Tuesday, make your money there, and then maybe take the pedal off for the rest of the week. So that's the week ahead. What we're going to do now is I'm just going to do a summary of kind of all of the lessons that I have produced already. I still recommend, if you haven't watched all of the lessons, go back to the start, watch the first 3 episodes in particular. The first episode is an introduction to trading. The second episode is all the nuts and bolts about trading, all the lingo, and you just need a base knowledge of what what you're going to need when you get into the charts and see real things. And the third video is just a tutorial on downloading TradingView, setting it up on your computer, and then you can be ready to go paper trading without your own real money, and having a crack in the markets. So what I thought I'd do today is I would just go back and look at a couple of days where we had a buy opportunity and a sell opportunity, and just walk you through those trades in sort of near real time, and give you a feel for how I trade this particular strategy. So let's just whip into TradingView here. Hope you can all see that. Show you a couple of cool features. The first feature is we've got a search feature up here, and I can go to any specific day. So I've just pulled out a couple of days in July that were interesting. So you can go to a date here, and the first date I want to look at is Monday the 14th of July. So let's just go there, go to. So here we are, starting Monday the 14th of July with this dotted line down the middle of the screen. And what I'm going to do now is I'm going to turn on a thing called replay trading. It's down here in the bottom panel, replay trading. Just click that and then launch the bar replay. And what you can now do is we can select a bar that we want to start at. So let's just select that bar there. So what we're looking at here I'll just get rid of this box. What we're looking at here is the close of Saturday moving into Monday the 14th. And what we can do down here is we can actually advance each bar of the chart manually. So I'm just going to click on this little move forward bar, and you'll see that we have now opened on Monday the 14th with this dotted line. And as we move forward, each one of these candles is 15 minutes. We're looking at the Euro USD on a 15-minute chart. And I'm just going to advance the chart until things get interesting. So this opening of the market in Auckland at 9 o'clock is what the professionals call a dead gap, because there's nothing really happening in the Auckland-Sydney session. So let's just move through that. You can see we opened with a gap down, and we're waiting for the Tokyo channel to establish itself. And the Tokyo market opens at midday, so you'll see as we come up to midday at the bottom of the chart, we'll get a little Tokyo. We now have opened the Tokyo session. This is the session that we want to keep our eye on. And the market makers will hold the traders within a channel during the Tokyo session for a few hours until they accrue a number of buyers or sellers. So let's just advance that. And what I normally do at about the 4 p.m. mark, so let's just advance through to say 4 p.m. We're going to see the market makers form this Tokyo channel. They'll move the price up and down to form the channel out. And we're coming up sort of 3 o'clock. We can see if we just move our mouse over the bar, over the candle, you see we're at 2:15 p.m. So let's just keep advancing that. 2:30, 2:45, 3 p.m., 3:15. So where are we at now? We're at sort of 3:30. So that's about the right time. And what I do is I just get this rectangle tool in the toolbar, and I just draw a rectangle around that initial channel that is formed, and I just bring it out to sort of after 7 o'clock somewhere. Okay, so let's just do that. And now I have a rectangle which is a guide for this channel, and what we're looking to see is whether the price breaks above or below the channel. And let's just have a look to see what happens as we move forward. So we keep going, still within the channel. Okay, now we see the price move below that channel, and it moves quite a bit down. Now what we're looking for in the bottom indicator, this TDI, is we're looking for the green line, the RSI, to break out at or below the lower volatility band. And when we get here, we're very likely to have a reversal. So let's just have another click here. Okay, so we've now pushed outside that volatility band. Okay, so a reversal is pending, and this is where I would take a buy position. So what's actually happened here is the market makers, the brokers, the big banks, those guys on the other side of your trade, they have basically created this channel. They've manipulated and controlled the price so it doesn't break out of this channel, and then they have sold aggressively. So they do a thing called circular trading between these big banks. They'll corroborate together, collaborate if you like, collude together. And what they've done is say, one of the really big banks, perhaps JP Morgan, has said to another one of these big banks, maybe Merrill Lynch, mate, I want to sell some euros to you, maybe $500 million worth. And in the chart, that's going to show up as a number of big red candles, and it's going to induce or entice the retail market, the 100 million guys and girls at home, that there's a breakout, that this is a breakout, what they call a breakout. So this move by the market makers is designed to capture and trap all of the breakout traders and then they will reverse the market. And as these retailers are liquidated, as the price moves back up and they get stopped out, those sell trades become buy trades, and then the bank will move in the opposite direction. So what I would do here, as soon as we get outside of this lower volatility band, I would go in with a buy. So what we can do in this replay trading is we can go down here to our buy and sell buttons. We can change the amount depending on your trade. It's a quantity in units. So perhaps we just want to go, my wife has a $5,000 paper account, so I basically encourage her to trade about 2% of that, so it's 25,000 units. So she would buy at this stage. She would click the buy button, okay, and that executes a buy trade. We can see it showing up in our charts. We can put a stop loss here of, let's say, 20 pips or whatever we like, and we can set a take profit. But really, for replay trading, we just want to keep our eye on things. So we're not so concerned about profit and loss targets here. But let's just now advance the chart and see what happens. So we're going to move along. You can see now that that the price is cut back inside the volatility band, and we've got a big green candle here. So this is more confirmation that the market is reversing, that the big banks are now going to trade in the opposite direction to the herd, liquidate them and book a profit. So let's just keep advancing that. You'll see now that our trade is in profit, $15.75 US here. So let's just keep advancing that. Next candle, slightly down. Next candle, see we've now opened the London session. The London session is the one that we're really trading here. It's the one where they make their big moves. So you can see we're now $36.50 in profit, and we'll just keep going here. Okay, so she's really rocketing up now. You can see these three big green candles. These are big financial institutions, and they are all aggregating in together. These 10 big banks are now all trading in the same direction, and they're all booking massive profits as this retail market is liquidated. So big bank A will have 50,000 of these traders with open trades that they are liquidating. Big bank B will have the same, big bank C, and as they all move in the same direction, they're all now booking big profits because they're effectively moving the money from the retailers' accounts straight into their accounts, because as these trades are liquidated, they're automatically closed and the money moves from the retailer to the broker to the big banks. So let's just keep playing here. You can see another green candle forming, and we're starting to get near the top of this volatility band. And when we are close, or we bounce out of it, again a reversal is imminent, and that's where we want to get out. You can see we're already $69.50 up in profit. So let's just keep going. Another candle. Shooting up, shooting down, a little consolidation here. This is normal. They'll move the market up, take a breather, try and attract more traders to the party, and then they'll go on another move. So now we are moving up, now getting pretty close to our upper volatility band. Up again, we've now cut outside the volatility band. This is where I'd look to exit the trade. We are $89.50 in profit. So what I'll do is I'll close this trade now. Boom, closed. You can see down here we've realized an $89.50 US profit. Let's see what happened. Okay, we've got a red candle forming. We've now got a reversal. So you can see we cut outside of that volatility band and we cut back in. So I would expect this price now to reverse. But we've got out at the top. It's exactly where we want to get out. We want to trade from the bottom and the top of the price range. We don't diddle in the middle. We don't diddle, anywhere here, because this is where the market makers will spike the market. It's where they will try and panic and freak out the retail traders, and we just want to ignore the noise. We want to get in early and get out later. So let's just see what happens at the end of this this trade. We've gone back up a bit. We've gone another red candle, up a bit more. Boom. The guts is now falling out of it. And now we're into the New York session. So we want to only trade this London session. New York opens at midnight. We want to be in bed well before then and have made our profit in a handful of hours. And that's a really good example of a buy trade, and how we use the specific pattern, the specific timing, and specific levels on the indicator here to get in and get out. So that's a buy example. I'll now go to a sell example. Right, that was a buy trade. Now we're going to look at a sell trade using the replay trading panel and trading view. So let's just whip over to that. So I've turned on the replay trading down here. Just click on that and launch it. I've gone to a specific date, which is Tuesday, the 8th of July. 8th of July. You can see we've just opened here at 9 o'clock in the morning. So let's just walk through that trading session. In this example, I'm going to show you a sell trade. So first thing to do is we're just going to advance a few candles. So you can see we have opened here, and we are waiting for the Tokyo session to open at midday. Coming up to midday here. Now anything prior to that you just ignore. It's called the dead gap, and we're not interested in it. So we have now opened the Tokyo session. You can see the start here of a blue box that will be painted out for you, and let's just see what happens. The market makers will basically form a channel here. They will pretty much control the price so that the traders can't go either side of the channel that they want to form. So you can see as we move further, I'm just going to see where we're at now. We're at 2:30 p.m. So we want to basically ride this out until about 4 o'clock to see where they have formed this channel. Okay, we are at 3:45, so let's give it one more candle. And there we have it. So I'm just going to blow this up a little bit. So at about this stage, what I do is I get my rectangle tool over here, and I draw a rectangle around the Tokyo session, extend it out to somewhere just after 7 o'clock where the London session opens. And there we have our rectangle. So what I'm now waiting to see is whether the market makers will push outside of this box, either up or down, and that will give us our bias as to the direction they're actually going to trade in, which will be the opposite direction to that false breakout. So let's just move these candles forward a bit. You can see down here I'm just clicking on this fast forward candle by candle, and let's see where we break out. So we've gone up slightly. Coming down. Okay, so we have actually broken above the box after the London session has started, and this is normal, guys. There's variations on a theme here. They don't always move the market at the same particular time every day. It can come before the London session opens. It can come slightly after it opens. In this particular case, the market makers have strongly pushed the price up after the London market has opened. And we'll just paint another few candles. You can see on the bottom indicator we are coming up close to the top volatility band, and if we break outside of that band and cut back in, this is the time when they will reverse the market. So let's just continue. Okay, so they came near this volatility band, and now we see a red candle, and this is where I would get into a sell position, because we are imminently going to have a reversal here. So I'm going to go select a sell trade, 25,000. Click that. We're in the market. We have an open trade here. We would set our stop loss at this point, 20 pips, which would push us, outside of that range. We were unlikely to get stopped out. The market makers are not going to come back to this level, because they want to entrap this bunch of retailers and liquidate them. And if they move the market further up and these guys are spooked, it releases them from their trades. They could just close their trades, move the money back into their accounts, and the market makers can't get their hands on that liquidity. So that's where I put my stop loss above the what we're going to call the high of the day, and our take profit we would set at 30 pips or somewhere near the bottom of the Tokyo session. It's a safe place to put it. So let's just now advance our trade and see what's happening. So yeah, we are now starting to reverse. Boom. Now these big banks are, this is their real intention. We're now booking a profit of $18.75. We're booking a profit in line with the big banks who are moving in the opposite direction to the herd. And let's just ride this out. Little consolidation, that's normal. They're now waiting to attract other sellers to the party before they make another big jump in the same direction. Coming down, we're now approaching this volatility band. This could be a good time to get out. We would be at the 50 period moving average, which is this blue line running through the screen here. This is probably where I would take my profit. So I'm going to close that trade there, $61.50 profit. I closed my take profit there instead of the actual trade. So let's just do that again. We're at $38, so we'll close that position. Boom. So we've realized a $38 US profit there. Let's see what actually would have transpired. Could have come down quite a bit further, and it has. And you can see that we're actually we're now riding the volatility band down. We haven't really broken out of it. We're riding it down further. And this 30 level is quite an important level. But we've already, we've passed our 50 period moving average. We've taken a good profit there. Let's just see what happens. Yeah, pushed right down. Look, still haven't broken back inside the volatility band here. We're now outside it, but we haven't broken back into it. So yeah, now starting to approach the 30. Very likely to reverse at the 30 or thereabouts. Starting to turn. Got a green candle. This is ominous that they could be about to reverse. You would have booked a really good profit here if you'd had a fixed profit of 30 pips. You would have made that easily. Okay, now we've cut back inside, and boom, we're on for a reversal. So if you'd even closed your trade here, that would have been a great profit. And yet, cutting back inside, have spiked up to the 50 or near the 50, and it's well over now. You should have been out and got out. Well, another crack at the another crack below. Never say never. Oh look, and now the New York market's open. So New York's renowned for its reversals, so I'm picking it would turn here, which it is, and after a bit of a consolidation, they'll move back up. Well, who knows? We would have been well out, so we would have booked a profit. And sometimes they'll just keep pushing down, which is the case here. If you'd held in, you could have made a massive profit, but that's trading. Nobody really knows. But if you take a sensible profit position and get out at the right time, it's the best play. Greed is the fastest killer of all traders, and it's easy to get sucked into going for more and more and more, and then losing losing your entire trade. So that's the lesson there. But that's an example of a sell trade, how we looked for the market makers to push outside of the initial Tokyo channel before they went on their true intention, which was to trade in the opposite direction, and they would have booked massive profits there. So that's how we've traded in line with those guys. So that's another good example. When we talk about buying and selling, and you'll see this when you take a position with the paper trading, it will ask you for an amount in units. And the reason for that is that the paper trading system is set up for most people who are either trading stocks or perhaps crypto, because when we trade stocks, we're buying units. If we want to buy 1,000 Tesla shares, we buy 1,000 units. If we want to buy 2 Bitcoin, we buy 2 Bitcoin. Forex, we trade in lots by default, but we can also trade in units. So if you go to babypips.com, let's just have a quick look at that, and you are trying to figure out how many units to actually trade with, as opposed to lots. You can come in here to Baby Pips. You can click on the tools. You can go position size calculator here, and then you put in your account balance if it's 5,000 US, and if you want to trade with 2% risk and a 20 pip stop loss, which is what I always recommend. The currency pair is going to be Euro USD, and you click calculate. You'll see here we have a position size. We've got an amount at risk of $100. We've got a position size in units, okay, 50,000 units. So that's the number you want to be putting into TradingView when you take a position, when you buy or sell, because these standard lots, mini lots, and micro lots, there isn't an option there to trade with those amounts. It's always in units when you're paper trading inside TradingView. So that's how you can calculate the right size there based on your risk in your account balance and what actual asset you're trading. So that's that. So that's probably enough for this week, but it's a definite summary of the trading pattern we are looking for, how to trade it actually with TradingView. We're looking at the big moves at or around the London session, when after the Tokyo channel has formed and the market makers have created what's called a false breakout. All the retail market with their technical training and books, they'll see that as a breakout. It's not. It's a fake move. It's designed to induce and entrap the traders before the market makers go on their intended trend in the opposite direction, and that's how they do it. What the retail market sees on the chart is what the big market makers are engineering for you to see. And that's the whole point. They can circular trade between themselves. Big Bank A says to Big Bank B, mate, can I buy 500 million euros? And, I'll sell them back to you in a few hours in the next session. That trade doesn't go through any broker, but on the chart, it creates a massive movement in price. This is how they move the market. And once they've moved the market, enticed and entrapped the retail traders, and then gone on their real intended trend in the opposite direction, they liquidate those guys and they all jump in, they all book big profits, and that's the way the game works. You know, if you understand how these big banks make money, they also have their own trading desks, don't forget. So once the market makers have moved the market and got the liquidity or the money they need by liquidating all those retailers, then they can trade from their own desks, and they do. And that's how they make massive profits. And when you're buying, they're selling to you. And quite often they'll sell to you at what's quite a low price in the market. And when they get out, you know, they're effectively, the retailers are then, you know, buying back from these big banks and paying a premium, and the bank has booked a massive profit in both their trading direction and also based on the inventory that they bought and sold, and that's how they make money. It's a money business. They're not there to see you succeed. They're trading in the opposite direction, and that's what we're seeing, and that's how I trade, and that's how it's really profitable. The retail market loses, you know, 90% of the time because of the trading 90% of the time in the wrong direction. They don't have a sense of timing. They don't have a sense of when these big sessions change over between Tokyo and London, or London and New York, and the characteristics of those particular sessions. We now know that the Tokyo market, the big banks are looking to control a channel, keeping the traders within a range, inducing them to take a position for you to click your mouse, buy or sell. And once you've done that, they can then, towards the end of that session, look at their dashboard, see that they have $500 million in open buy trades, and know that if they stop those traders out by moving the market, they'll clean up $500 million. And that's what they do every day. So anyway, that's enough from me. Hope you enjoyed that, and we'll see you next time. Until then, you know, I've probably given you enough education. You've got to get in and have a crack yourself, so go ahead and do that. My wife has been very successful this week, first week trading. She's made her $100 US. She's very happy with that. It's paper money, but, you know, she hasn't, well, I think she's lost 2 trades in the whole week, so, you know, well done. So over and out, and we'll catch you next time. Cheers.